Welcome. This chapter, chapter 3, is Principles of Option Pricing. Really what it covers is boundary conditions for the options price. And what I mean by boundary conditions, basically limits. How high can the price go? How low can the options price go? And what drives those what drives those limits? What are the factors driving it? So this will be, a slightly abstract chapter. Content slightly abstract, but it's all going to be about pricing and meaning valuing options. Pricing and valuing are used interchangeably in this chapter. So, why do we need to know boundary conditions? Well, kind of already hinted at it, is when you understand the boundary conditions that we're going to apply and the reasoning that we're putting on these conditions, you'll better understand what drives option values. The other reason is if you know what the boundary conditions are, you can exploit arbitrage conditions if you find an option that's outside those boundaries. So if you, in other words, there's a space where option values are supposed to be. I will draw you that space in a bit, but we're obviously not there yet. But there is a place for option prices. There's a space, a relevant space for the option price to be. And if it's not in that area, then it implies or suggests that there's an arbitrage opportunity. And then the third but related reason why we're looking at these boundary conditions is we can actually use those boundary conditions to help value the option. So let's get forward and let's look at the principles of call option pricing. We'll focus on call options first, and then we'll go into put options later. So there's a lot of terminology, symbols in this chapter. And as I go along and unpack the chapter, I'll cover what those symbols represent. And it's very compact notation that you need to get comfortable with. It's really not that bad and when I go through it, but you got to get comfortable with it, because when you read the textbook, you're going to run headlong into that notation. Okay, so let's look at what the minimum value of a call option is. How do we represent the minimum value? Well, remember what a call option is. A call option gives you the right, but not the obligation to purchase a stock at the expiration, at the strike price up until expiration. Okay. Now we're going to get into and talk about the difference between European and American options. Remember, European options can only be exercised at expiration. So there's only one point in time you can exercise a European option. That's at expiration. American options are to give you much more flexibility in that you can exercise the option at any point when you own it. Anytime before expiration, you can exercise it. And we'll talk about whether or not it's worthwhile exercising early or not. That's part of the conversation here in this chapter. But for now, what we want to do is let's look at the minimum value. In other words, the lower boundary condition. So I say minimum, how low can it go? And let's look at an American call option. And so we're going to denote it by CA, that's the value of an American call, CA, as a function of, and this is where you don't want to get confused on this. Let me write it out. So what I'm saying here is we're valuing an American call, but when I talk about valuing an American call, like, well, give me some parameters. Like, what's the stock price right now? What is the expiration? How long do I have till expiration? What is the strike? Those are the three very important components that we need to know the value of the option. Okay, so when you see this notation says this is the value of an American option based on the stock price, whatever it is. It could be 45. We could put a 45 here for a $45 stock price. T could be 1/2, which means it's a 6 months or a half a year, and the strike could be 40. Okay, so we're not going to put the numbers in. We're going to be more generic than that. and just say, look, here's the value of an American call. And what we're saying here is the value of the American call has to be greater than or equal to the maximum of 0 or what's called the intrinsic value of the call option. Okay, so the way to read this is the maximum of either 0 or S minus X. Okay, so it's going to be it's going to be the larger of the other. So this can never be negative, is what this is saying. An option value can never be negative because think about it. The option gives you the right, but not the obligation. It's not forcing you to do anything you don't want to do. So this option will always have a 0 value or positive value, never negative. Okay, and this notation may look strange to you, but literally, if you use this notation in Excel, for example, Excel knows what to do with this. So the notations can get quite handy in knowing, if you put in Excel and you type in the symbol correctly, you'll put in, equal max and then 0, say 45 here. It'll give you 45 out as an output. Okay, so that's the first item. So what it's saying is, look, the value of a call option is either 0 if it's out of the money, at or out of the money, the option is worthless. And if it's in the money, this is how much it's worth. SX or S minus X, the intrinsic value. So let me give you an example. Okay, suppose ABC stock trades at $40. Well, as soon as you see a stock price and it's today, S subscript 0 is 40, and you own a 3-month option. Well, that means T is 3 out of 12. Almost always in this course, we're going to have various options and futures and swaps that have maturities, and T is usually a fraction of a year. And so 3/12 here would be a quarter of a year for this option. Okay. Now, if you had an option that lasts a year and a half, that would be 1.5 because it's 1.5 years for the option. Okay, so here this is only a quarter of a year option. And then we have a strike of 36. So notice it's lining right up with here. It's telling you what the stock price is. It's telling you the time. It's telling you the strike. Now, from this information, what is the intrinsic value of the call? What is the call intrinsically worth? So this is what it's intrinsically worth if it's in the money. If it's at or out of the money, this is what it's intrinsically worth. So this I like to point that this is the intrinsic value, the S minus X. I should be clear that it's technically, this whole thing is intrinsic value. It's just that you have no intrinsic value when it's at or out of the money. The actual value comes about when it's in the money. Okay, so we'll call it IV. Let's just call it IV for intrinsic value. And that equals the maximum of 0 or S0 minus X. So let's plug the numbers in. So it's the maximum of 0 or 40 minus 36. And that means it's the maximum of 0 or 4. So what's greater? The maximum is 0 or 4 is 4. That's because we're in the money by $4. So this option is intrinsically worth $4. Now again, back up. Why is it worth $4? Because you have an option that allows you to buy the stock for 36 when it trades in the open market for 40. Well, that's a good deal. That option is worth at least $4 per share. Okay. Now let's look at what happens if the stock instead here. What happens if the stock is $32 per share? What is the intrinsic value of this guy? What is this? So with $32, it's the maximum of 0, or 32 minus 36, which is negative, right? So what's the greater of 0 or a negative 4? Well, it's 0. This option is out of the money. It's intrinsically valued at 0. Okay. Now, you might ask, wait a second, why would anybody want to buy an option? This last option I'm looking at. where the stock price right now is 32, but the strike is at 36. Who the heck would ever want to buy this option? It's out of the money by $4 basically, and it has an intrinsic value of 0. Why would you ever buy it? Well, there's people that would be speculating that this stock price could zoom up to $50, for example, in the next 3 months. So there's 3 months left of this option. What if the stock goes to 50? This is a valuable option if that happens, because this will be, deep in the money. The optional, the intrinsic value would be 50 minus the 36 will be worth $14 a share. So that's why people buy out of the money options. They're either out of the money or at the money, because they're, well, one, they're cheap, so you don't have to spend much money, but two, people are speculating that it's going to go in the money in their favor, and so they're willing to buy out of the money options to do that. Okay. So what that's sometimes called, and what we're referring to, is sometimes called a speculative value component to an option. Now let's get to the maximum value. And we're going to look at call options now. Okay, so we're going to look here that the maximum value can be written. Let's use that notation again. C, stock price in today, expiration time is a fraction of a year, and the strike. Okay, and that's going to be less than or equal to stock price today. And so first thing I want you to notice is, you notice I didn't put a little a or an e here. Okay, a little a for American, a little e for European, because this concept applies to either European or American. Okay, and so what it's saying is, look, the stock price has to, the call price, the value of the call, which is right here, has to be less than or equal to the stock price. Okay, so it's an upper bound. Call option can never be worth more than a stock. If you really think about it, a call option can never be worth more than a stock, because the only thing that you can do with the call option is exercise it and convert it into a stock. That's all it's worth. I mean, that's all you can really do with it. I mean, you can sell the call option, but we're talking about what can you do if you hold a call option? What can you do with it? You can only exercise it and exchange it for the shares of the stock. So the call option itself can't be worth anything more than the underlying stock that it can be converted into. Okay, so this is an upper bound. That's what we mean maximum call value. It's an upper bound. Okay, and this upper bound can be hit under two conditions. And we'll see this later, it's pretty cool. If x equals 0, if you have an option with a 0 strike price, then basically the call option is equal to the stock price. Okay, the call is the amount of the stock price. Or the other case would be if you let t go to infinity, so you have an option that never matures, then the value of the option is going to equal the stock price. Okay, now you're never going to find an option that has an infinite maturity, but it's more of a mental exercise. And we'll go through that exercise a little later. And you'll see it's pretty interesting how we get that upper bound and how to think about the difference between a call and a stock price. Okay. Now, the next boundary condition that we want to do, or it's a boundary condition, is we want to look at the effect of time to expiration has on an options price. So the longer the time that an option can be outstanding, then the more value it has. And so long-term options are more valuable than short-term options. Now, the way to wrap your head around that story is, think about it. Options contracts are kind of like insurance contracts. They can be used like insurance contracts to offset risk. I'll show you that throughout the entire semester. So if you go and you buy auto insurance or house insurance, and you want to insure let's say it's your house. You want to insure your house for 1 year. What is the price of that contract? And then what is your price of that contract if you only want to insure for 6 months? Well, obviously the 1 year insurance contract is more valuable to you, and you're going to pay a higher price for it. It covers a longer period of time. That's the way that it's that logic, that analogy that applies to options contracts. Long-term options have more value than short-term options. And so we can simply denote that as, and by the way, it doesn't matter if it's European or American. So here you see my notation here without an A and without an E. So the way to write that out notationally is the value of a call with a long-term call, because the time to maturity is T2. T2 is greater than T1, which is the short expiration for the contract. Then you can see the longer term option is worth more than the shorter term option. Okay, so so this time, so really what we're looking at is there's a time value component to options. So there's a time value. I'm going to show you that in much more detail in a little bit. But time value in part depends on the moneyness of the option. Time value depends a bit on, is the option deep in the money or deep out of the money or at the money? It turns out when an option is deep in or out of the money, so the option is deep out of the money, that means the stock is way below the strike or it's way above the strike, then the time value associated with those options is small. Okay? The time value is small. The time value tends to be the largest right around the strike. Again, hold off till I show you a graph of this and it'll make much more sense. Okay, so now let's go further and let's look at the effective exercise price on a call. The lower the exercise price for a call, the more valuable it is. And this is another one of these conditions where it doesn't matter if it's European or American. And so we basically have call price, yes, stock price today, time, and we're going to deal with X now. So X1 means a different strike than this one, this option, with strike X2. X2 is greater than X1, okay? So what it says is the lower the strike here, the lower the strike, then the more valuable the option is. And so what that means, I mean, if you think about it, that makes a lot of sense, because when you exercise an option, the strike is what you're paying for the stock. And if that strike is really low, then you're paying a low amount for the stock. And so all else being equal, which is very important in this chapter, when you're changing variables, all else being equal is really important. We're just changing the strike. That's it. And the lower the strike, the better. Okay. Now let's look at the lower bound of a European call. So remember, we looked at the lower bound of an American a little earlier. We said the lower bound on the American. It's when we first started out with these conditions. We said, look, here's the lower bound. It's the intrinsic value. Intrinsic value when you're in the money, intrinsic value when you're at or out of the money. The entire thing is technically the intrinsic value. Remember, the authors say it only applies to American, but I said, look, you know, this concept actually applies to European. So let's adapt this concept. And look at the and try to massage this so it applies to an American, or excuse me, a European option. So now the intrinsic value for a European call, okay, and I'm going to denote the intrinsic value, and we're going to use that as a lower bound for the European call. And it's going to look like this. This is the punchline. Okay, that is the punchline to what I'm going to show you and prove it to you shortly. And what this says is, look, with a European call, with a stock price S subscript 0, certain expiration, and a strike, it's got to be greater than or equal to, which means the call has to be greater than this. It's a lower bound then, has to be greater than this number. So this is the intrinsic value of a European call. And the only difference is it's this component, right? Let me get green here and see if you can see it in green. The only difference is we're dividing the strike by 1 plus R to the T power. And so what that says, and if you remember your basic finance course, this whole term is nothing but the present value of the strike. It's the present value of the strike price. So if the strike price was 100, for example, then you would take 100, and if the interest rate was 10%, and you take it to the 1 power for T, which is equal to 1 if you had a 1-year option, then the present value is $90.91. And so the reason why we're really discounting, we're taking the strike, this is X, discounting it, and we're putting in S minus the $90.91 here, is because with the European option, you cannot exercise it until expiration. So if expiration is 1 year from now, you're not going to pay X at this point. The value of X is $90.91. And then as time goes on, this amount here will increase to the $100. So the point is, what is the present value of what you're going to pay? $90.91, because you're not going to pay this $100 until 1 year from now in this example. Okay? So therefore, what this does is, this means that the European, from this reasoning, the European's intrinsic value is going to be greater at times. When it's in the money, it's this with an X that's a little smaller. When you adjust X for time value of money, it's a little smaller, which means this difference opens up and gets bigger. This difference right here gets a little bit bigger. Okay. Now, what I want to do is show you prove to you how this works. So how do I know this works? I gave you the intuition, and that's enough. But when we get deeper in the derivatives contracts, and look, we're in financial engineering, things may not be this simple. They may get more complex. And you see, you need to think about, well, how can I look at this from a stronger position? And that's where we're going to prove this situation. We're going to prove this boundary condition here. And we're going to prove it generically without numbers, literally with symbols. And that's where the value comes in. If you can prove it with symbols only, that means it applies to every situation. So if you just prove something by example and you put in actual numbers, then how do you know if you change the numbers, things don't change, and the proof doesn't work? So we got to employ it with letters, symbols. Okay, and the way we're going to do that is we're going to look at two portfolios. We're going to have a portfolio A, and portfolio A is nothing but a stock. You're long a stock. Okay, so we're going to look at two portfolios, A, and then we're going to look at portfolio B. We're going to compare them and try to prove that the intrinsic value that I just showed you is the underlying value of the option. So we're going to derive this. You would never think about doing this on your own. People who've been working with these options for decades and decades have figured this out. On the surface, nobody would ever really think about it. But you're in a derivatives and financial engineering course, and people have spent lots of time over the past 40 years evaluating these things. So we have portfolio A, and that means you own the stock. And then we have portfolio B. And portfolio B is going to be composed of two things. It's going to be composed of, you're going to own a stock, own a call option. Okay, you're going to own a European call, and then we're going to own a bond. Okay, and the bond will mature. The bond will mature at X, at maturity. Okay, and so what we want to do is we want to compare these two guys. at these two portfolios and see how they turn out. And from comparing those two and assuming no arbitrage conditions, I'm going to show you how to come up with that intrinsic value. Okay, so here's how we do it. We're going to have, we're going to draw a box here, portfolio. We're going to have portfolio A, portfolio B, and we're going to have the current value. Okay, and then we're going to have payoffs. And you're going to see this type of logic used throughout the course. We're going to look at payoffs when the stock, excuse me, the option is out of the money. So when the stock price is less than the strike, these call options are out of the money. And then we're going to look at what happens when the stock price is above the strike, when the option is in the money. So that way we cover every base. Is it out of the money or in the money? We've covered 100% chance of whatever's going to happen, because an option either finishes out of the money or technically at the money with that little equal sign there, okay? Or it's in the money. So when you own a stock today, what's the current value of the stock? Well, that's S subscript 0. When you're long a stock, the current value is S subscript 0. Now, what is the value of the stock at expiration? Well, at expiration, and I should say here, at expiration, the value of the stock at expiration, it doesn't matter if the stock is less than the strike or above the strike. No matter what happens, the stock price is ST. Okay? The stock price at expiration is ST. Now, that was not too hard. Part B, portfolio B is a little more complex because we have a call option. And so here's the call option notation. It's call, it's a European call. It's the stock price, X time the expiration, and strike. Okay, so we own this call option, okay, plus we own a bond. And the bond pays off X. It has a maturity of X. Okay, so this is a little abstract, but bear with me. You're going to see it again, and it makes a lot of sense. The option is, the bond is going to pay off X at maturity. But right now, that bond, what is its current value? The current value is the present value of that strike. And so what we're going to do is we're going to take X and we're going to discount X based on this R, which is, by the way, recall, it's the risk-free rate over a period of time. Why is it the risk-free rate? Well, we'll talk about that, because basically what we're going to talk about it throughout the semester. We're really setting up zero risk situations. And if we have zero risk situations, we discount things with the risk-free rate. That's one way to interpret it. I'll have other ways to try to interpret that logic later. But think of it that way. And so what do I mean by risk-free? Well, bear with me. Let me continue here. So now let's look to see what happens when, here's the portfolio of the call plus a bond. What happens, what is the payoff when the option is out of the money? Well, this guy turns to zero. The call is worth nothing at expiration when it's out of the money. Okay, call is worth zero. What is the bond worth? Well, this bond pays off X no matter what, so it's basically a risk-free bond, and so it pays off X. So in this situation, the payoff here for this portfolio is simply X. Now, what is the payoff in this situation? Well, when the option is in the money, that's what this is saying. What is this option worth? It's worth ST minus X. This is the intrinsic value at expiration when it's in the money. Okay? And then this bond is going to be worth X also. Okay? So no matter what, this present value here, think of it, if you want to put a number to it, the $90.91, it's going to grow to 100 or 100. Regardless of where the stock is, the bonds is going to pay off $100. So now, if we compare these two situations, oh, by the way, let me get this in green here. Minus X plus X cancels. You notice that? So these guys cancel out. You still have this ST, by the way, but the X is canceled. And so now let's compare the two portfolios. Okay. Now, in the case of the option being out of the money, which is better, portfolio A or portfolio B? Well, if you look at this, the winner is portfolio B because X is greater than the stock price. So compare this to this. According to the setup here, this is the winner. B is the winner, portfolio B in this scenario. Now, what is the scenario when the stock price is greater than the strike? Which is the winner? Well, it's actually tie. Okay, it's tie. So you can basically ignore this situation since it's tie. And what you have is portfolio B dominates portfolio A just because of this situation. It dominates. Okay, so how do we write that? Well, we could write that today, meaning the European call plus the bond at today's value, okay, we're looking at today's value, has to be greater than or equal to the stock price today. Okay, so we want to look at what is it worth today. And we're saying based on these conditions, we know that the bond and the call are worth at least or greater than the underlying stock itself. And so we can rewrite that, rearrange it. And the rearrangement becomes CSTX. Wow, so that kind of looks interesting. What this is telling us is the intrinsic value has got to be worth, this call option has to be worth this difference. And that's the European intrinsic value, basically. That's the European intrinsic value component. And so if we combine that with the fact that a call price can never be negative, then we have the value of a call. Oops, move this paper down a little bit. The value of the call is going to be greater than or equal to the maximum of 0 or the stock price minus the present value of the strike. And there we have it, the proof behind the lower bound on this European call. And so this logic is very valuable in trying to put together boundary conditions and also for valuing the option. So it's very important to get a handle on this. Now, as I promised a little while ago, actually, I'm going to draw you the boundary space. And the boundary space sounds like, oh boy, what is this? But trust me, when I put this on paper, I think what I've just done since the beginning of this chapter is going to start to make sense. And so here's what I'm going to do. Get this cleaned up. What I'm going to do is show you the boundary conditions and the space in which an options price should be for both American and European. So I'm going to draw a nice graph. There's space in your notes for this graph. So here we have the stock price, and here we have the call. And you can call that C if you want without an E and an A, because I'm going to put both on here. Okay. Now, what I'm going to do here is I'm going to show you the maximum value of a call option. And the maximum value of the call option is right here, basically a 45-degree line here that says the value of the call equals the stock price. That's the upper bound here. And remember I told you the upper bound could be looked at in two situations. Remember, let me give you a little from a European perspective here for a second. If we have that as being the intrinsic value of the option, right? if we have x equals 0, put in a 0 here, then what happens to the value of the call? The call is equal to the stock price. You see that? Or, so when the strike is 0, as I said, like 20 minutes ago, then the value of the call is equal to the stock, because mathematically that works out. Well, what happens if the t value, you let this option go to infinity? In other words, let's say we had an option that never matured. Well, if this goes to infinity, then this whole bottom gets bigger and bigger and bigger to the point where this whole term drops to 0. This whole term goes to 0 because you're compounding forever, and the bottom, the denominator, gets bigger and bigger and bigger while x stays constant. And so again, the call is equal to the strike. So that's the maximum that you can have. So this happens when t goes to infinity, or x equals 0, you'll get that upper bound. Upper bounds means at this point you can only be below. See where my hand is? That's the place where the stock price can be. We ruled out everything up here. Can't be up here. It's got to be down here. But let's tighten the boundaries conditions a bit more. Now we know the strike price, let's put an X somewhere on this graph. And so there's the strike price. And let's look at the payoff for an American. So here we have an American, and the payoff is the maximum of 0, or S0 minus X. So remember, this is a lower bound. Okay, so in other words, we're ruling out lower bound, meaning it can't go below. See where my hand is? It can't go there because that's the lower bound. When it comes down, it hits this line. And that line is denoted as the maximum of 0 or S minus X. So that's the American boundary. So think about it. When the stock is out of the money right here, then the option is worth nothing in a sense. It's on this 0 line for, the payoff is 0 here. Then it's at the money. And then when it starts getting in the money, every dollar it goes in the money. See this? Every dollar it goes in the money, this S goes up, this whole term goes up. And that's what we see on this line. Okay. Now the European payoff, or the lower bound payoff, is going to look like this. And that's the European one. And so I'll just call it Euro. And remember, that is the maximum of 0, or S minus the present value of the strike. And so, by the way, now's a good time for me to tell you this. You're going to see payoffs that look like this, just S minus X. You're going to see it with divided by 1 plus R to the T. Whenever you see something that's discounted like this, it's almost always going to be a European option. And if you don't see it, it could very well denote an American option, or it could be that the option is just no time left. And if there's no time left, then both American and European options are worth the same amount. So American and European options are worth the same amount at expiration. And what is that worth? Well, at expiration, they're both going to equal this. At expiration, they're both going to be on this line. Because, think about it. At expiration, both options can do the same thing. You can exercise them if they're in the money, or if they're not, you don't. You don't get any extra benefit from the American because there's no time left to get any extra benefit of that optionality to be able to exercise. Okay, so at expiration, you're on this heavy black line. But before expiration, this boundary condition here is telling you that it's a bit higher. It's a bit higher. Okay, and so this gap, this difference right here between my fingers here, this gap right, these two numbers, two areas of space, is this space right, is calculated by this. Okay, it's going to be bigger than this difference. Okay, so this is the European boundary. Now, and this is the European boundary now. This is the European boundary before expiration. Okay, because as the contracts expire, as these European contracts expire, this line right here will melt into this dark heavy line that I'm overlaying right now. This line will slowly sink. I'm not doing a good job of that. This line right here will slowly melt into this heavy line that I'm over right now as time matures, because as t goes down, this difference will drop. The difference between these two. As t goes to 0, this whole term drops out when t goes to 0. So now we've got an idea of where the boundary condition is before expiration. The boundary conditions for European and American, with the logic that the American can do everything that a European has. So this boundary condition before expiration is an illusion, basically. This is an illusion before expiration. It applies at expiration, but before expiration, this is the lower bound. You can't go below this upper line here. Okay, and then as time goes on, and at expiration, both the American and the European are worth the same amount on this line, because they both can do the same thing at that point. It's either exercise if it's in the money, or if it's not or at, don't exercise. Okay, so now what we just said was everything in here, everything right here, my pens are covering, that is the boundaries. That's the space where, that's the space where an option price can hang out, in that space. It can't be above where my hand is. It can't be below, depending on whether it's European or American and whether or not it's at expiration or not. It can't be below here. It can only be where my markers are. And so we can actually go even a little further than that and say, and I'm going to show you what option values actually look like graphically. Option value, they kind of look like this. The actual option value, while it can be anywhere theoretically in this space I just showed you, they tend to look like this. This relationship here. And the longer the maturity T, then the option's worth more. It's worth more as T goes up, because I'm keeping X fixed. I'm keeping the stock price fixed, except for the change here, keeping it fixed. As time goes up, the option's worth more money. And then, as I said like 20 minutes ago, I said, look, when the option's deep in the money, the time value is not worth very much. It's deep out of the money, the time value is not worth much. The call is almost worth nothing. And here, the call is worth a lot, but it's made up of intrinsic value. This time value is very small. So when the option's deep out or in the money, the time value is small, as we said a while back, and it tends to be at its greatest right here, where the stock is about equal to its strike. Or, if you're right at expiration, it's going to be looking like this. It's right at its maximum. Okay, so it's right around, depending on time value of money issued, it's going to be around the strike. It's not going to be way up here. It's not going to be way down here. It's going to be when you're near the strike, okay, especially as you approach expiration. Okay. Now, let's look at another situation here. Let's look at dividends. So, let's make sure we have our head on straight about how dividends work in the world. Now, you know that when a stock pays a dividend, right? When a stock pays a dividend, it reduces the value of the stock, right? So if we have an option, here's a timeline. We're looking at valuing the stock today, and then we want to value the stock at expiration, because we want to know what the value of the stock is at expiration, because that's going to determine the value of the option, whether it's in or out of the money. What we have to keep in mind is this stock price here will reflect any dividends the company pays over the life of the option. So this is a 1-year period. For simplicity, this is a 1-year period. The company pays a dividend in here. What that means is this stock price right here, this stock price reflects the fact that the dividend is going to come and it's going to reduce the stock price, because when a company pays a dividend, it reduces the stock price. The stock is going along, and as soon as it pays a dividend, the stock is going to drop in the amount of the dividend, all else being equal. And some people think, well, wait a second, when a company declares a dividend, a bigger dividend, the stock price goes up. But that's not what I'm talking about. I'm talking about when the company pays the dividend to its shareholders. And the way that it drops the stock price, the way to think about that is go to an extreme, and sometimes going to extremes is really helpful logically, is what happens if a company pays a liquidating dividend. It liquidates its entire company and pays out this gigantic dividend. What is the value of the stock? Well, zero, because you just liquidated the entire company and it's not worth anything anymore because you gave it all the money to the shareholder. The stock is worth zero. The company can't do anything without any assets. And so that's one way, that's how to think about it. So what we need to consider here is an adjustment. So long-winded is what I'm trying to say is we need to take into consideration the fact that a stock will drop in value because of dividends it pays during the life of the option. And when a stock drops in value, okay, that's going to reduce the payoff for an option. So think about it. The bigger the dividend the company pays over the life of the option, the more it's going to knock the stock price off. So what people do is they need to make an adjustment for stock prices when they look at valuing options. And the way they do it is that we compute an adjusted stock price. And so S with a little gizmo here, an apostrophe type thing. So S subscript 0, stock price today adjusted for dividends. We're going to say that that equals 0. The stock price today times that subscript 0 times 0 minus the present value of all the dividends paid during the life of the option, not beyond, not in the past, just during the life of the option. What is the present value of those dividends? So if the dividend is going to be $1 and the dividend gets paid right here, right before expiration, then you're going to discount that back by, if interest rates are 10%, you're going to discount that by 10% over a year. This is going to be worth about 91 cents. Is the present value of the dividend. So you're going to take whatever the stock price is and subtract 91 cents from it. And we're going to use this adjusted stock price for the intrinsic value. Okay, so you buy a stock, this is what it's worth, but you know it's going to pay a dividend in this case, over here, it's going to pay a dividend in the future, then you need to drop this stock price by the amount of dividend that will be paid off. Okay, and the reason, if you go deeper into thinking about this, well, you buy the stock at this high amount because you know you're going to get the dividend in the future. So you buy the stock, right? And then you know that you're going to get this dividend. So this stock is a package of the underlying stock right here in that future dividend. That's kind of another way to look at it. Now the question becomes, and I'm often asked this question, should an American option, call option, on a non-dividend paying stock ever be exercised early? And actually, I don't get, that's not the way the question is phrased to me normally. The question is, why can't I just exercise my stock or my option right now? And the implication is when somebody's telling me they want to exercise an option now before it expires, it implies it's an American option. Okay, and what people don't bother to tell me, because they don't realize the implication here, is they don't realize that they don't ever think that the dividend plays a role in the exercising decision. And I kind of just told you a minute ago that it does. And so let's look at that. Should we exercise an option early, a call option early, rather than waiting to maturity? Or that's one thing. But don't forget, and people forget this all the time, is that when you tell them, well, people, they're all anxious to exercise an option, and they're anxious, they want to exercise the option. but it almost always with call options on stocks that don't pay dividends now, it's almost it doesn't make sense. You're actually throwing money away by exercising an American call option early. And that's what I want to talk to you a little bit about right here. And so is there a time when we should exercise an American option early on a stock that doesn't pay a dividend? And the answer is no. You never want to exercise a call option early on a stock when it's an option on a stock that doesn't pay a dividend. And the reason is you're literally throwing a pile of money away with the call. What people forget is they forget that if they bought the option, you just sell the option if you don't want it. You don't have to exercise it. People somehow think that they're bound and they have to exercise it if they want to get rid of, they want to get rid of it, or they want to get the stock, or it's in the options in the money. I got to exercise it. I got to exercise it. I got to exercise it. And I'm telling them, no, you probably don't want to exercise it because you're just throwing money away. And that's what I tell students. Well, if you want, you're better off selling the option rather than exercising the option. And most people just don't, it kind of goes over their head. But look, if you bought the option, you can sell the option. And then they're like, oh, okay. But let me go into a bit more detail about how to break out the value of either a European or an American. It doesn't matter conceptually, this will work. You don't have to really make differences between American or European. So let's look at that decomposition, and then we can figure out, when should I exercise an option or sell the option, and what are the trade-offs? So that's where we're going here in the notes. Okay, so let's look at a call value. That can equal intrinsic value plus what I'm calling is pure time value. This decomposition, meaning breaking call options into these three components, this is not in the book. Okay, I'll show you what is in the book, but this is not in the book, but it's very helpful. So what I'm going to do is I'm going to break a call option into three components. The component you've already seen, intrinsic value, a pure time value component that has to do with, for example, delaying a European strike, delaying that payment. Or even if you're an American option, if you hold on to the option, you're not paying the strike right now. And so there's still a time value element to it. And then there's also an insurance value component to an option. That's everything left over. So when you look at a call option, you know what this number is. You can get that from the CBOE, the Chicago Board of Options Exchange. You can figure out the intrinsic value, which is what I've been showing you. The max equals 0 or comma 0, or the intrinsic value if it's in the money. And then there's a pure time value component, which we've been dancing around, and I'll show you in a second, that you can calculate. And then this number right here, the insurance value, is everything that's left over. And so mathematically, what this boils down to is the maximum of 0 strike minus x, okay, plus x minus present value of x, and then we have insurance value. I'll call it abbreviated. Okay, so here's the intrinsic value that we've been looking at. And so I kind of moved the present value component, that discounting, over into this component. So the difference between these two components, the strike and the present value of the strike, is this component. That's what I'm calling pure time value component to an option. It has its intrinsic value, and whatever's left over gets dumped into the insurance value, because that's the most difficult part to evaluate. And that has to do, the time component of the option, how volatile the underlying option is, all that gets thrown into the insurance value, as we'll talk about a little later. Okay, so what you see here is that the intrinsic value plus this time value. Now, why, what you may not ask, and may not even think to ask is, well, why is that positive? Why isn't it negative? Well, it turns out to be positive for a call option because when you have a call option, you're holding the call option, you can defer exercise. You can defer the purchase of the stock. So when you exercise, you have to purchase the stock. And when you have to purchase the stock, you have to pay money. The fact that the call option is giving you the right to buy at any point in time, or before expiration, you can get this long position in the stock. Then this difference here, that from you delaying the purchase of the stock, that's valuable to the call option. So call options become more valuable when interest rates are high. Okay? So I'll say it again. When interest rates are high, this component right here is more valuable. It means the call is more valuable. So let me give you some more intuition behind that. When an investor is bullish on a stock, the investor expects the stock to go up. There's two ways to get a position to take advantage of that. And we've talked about this before. There's two ways to do it. One, you buy the stock outright. That's what anybody who took this course before you started the course, you knew, if I think a stock's going up, I'm just going to buy the stock. Okay, correct. Now we're dealing with options, and we have a call option. So if you think the stock's going to go up, why not buy a call option instead? Because the call option is going to go up if the underlying goes up. But not only that, but it makes sense to buy the call option because usually the call option is substantially cheaper than the underlying stock. So when you go and you buy, if you want to just buy the stock, you have to shell out, say, $100 for the stock price. That's opportunity cost of money. If you have to buy the stock, you have to shell out money. And when interest rates are high, it hurts to buy that stock because you can get a high interest rate elsewhere in the economy. Now compare that to the call option. Call option could only be worth, call option could only be worth $2. You're going to shell out $2 rather than $100. That means the call is way more attractive when interest rates are high because you only have to shell out $2 and you only have opportunity costs associated with that $2 when interest rates are high. The call becomes more valuable when interest rates are high. And so there it is. That's the plus sign here. When we look at puts, to give you a hint of what's coming in a little while here in this video, is when we get to a put, this is going to be a negative sign right here, which means there is value in exercising a put option early because you get the proceeds from the stock. Remember, puts give you the right to sell. So you get the stock. So you get the cash proceeds for the stock, which means you can invest the stock at those high interest rates. So there's going to be a negative sign coming up when we deal with puts. Okay, so now we're in a really good situation to ask, should I ever exercise an American option early when there's a dividend on the underlying? And the answer to that is maybe it is, maybe it's not. And we have right in front of us the issue that's involved. Okay, so what the question boils down to is, if I exercise an option right now, if I exercise the call option right here, and obviously if I'm debating exercising, it's got to be in the money, by the way, right? See, let's get that straight. So we're not really here. So that kind of goes away. So if I exercise the option, what am I going to get right now? All I'm going to get is this right here. If it's in the money, it's all I'm going to get is the S minus X component, because I'm going to get the stock and I'm going to pay X. That's why the negative sign is in front of the X. I'm going to pay X and I'm going to get the X. The stock price technically is a little plus sign here, but nobody ever puts the plus sign here. But the plus sign signals in this analysis, you're getting the stock, you're paying the strike. Okay, but notice what happens if you exercise the option right now. You just threw away this positive component that I spent 5 minutes explaining, and then you threw away this insurance value. You literally threw it away. Why not, instead of exercising the option, why not just sell the option and get this in terms of cash and get this in terms of cash, and then you're also going to get this component in terms of cash. So the point that I'm making is it doesn't make sense to exercise an option early because you're throwing these two components away, okay? That's for a non-dividend paying stock. But now when we introduce dividends, now think about it. If you exercise the stock now, you get the stock and then maybe you have access to a dividend that's coming up. And if you have access to a dividend, that's good, okay? So you exercise the option and then you get the stock, and because you own the stock, you get the dividend, okay? Maybe that's more valuable than selling the option. Well, the way to evaluate whether or not it is more valuable is you need to look at these two components right here. Is the value of these two components that you're giving up upon exercise, is that greater than or less than the dividend that you're going to get? And if the dividend is greater than these two values right here, then you're going to want to exercise the option early. On an American option that pays a dividend, exercise it early because you're going to get the dividend. And if the dividend is greater than the two components you're throwing away, then get the dividend by exercising. If these two components are larger, you're better off just selling the option, taking the cash, and walking away from it. So really what it boils down is the size of these two components. Now, what it really often boils down to is this component right here. This could be big if interest rates are high. There's a long time period involved. This difference could be big. The pure time value could be a big number, but often not. Our interest rates are pretty low now. And if it's under a year, there's not going to be that much of a difference between these two numbers. What it's really going to boil down to is how much insurance value is on the option. And it turns out insurance value is highly related to how volatile the underlying stock is. And I'll talk about that in a few minutes. Okay. So now what I want to do is talk about the effect of interest rates on options. Because we're kind of right here. Let's talk about it. And then we'll talk about volatility. Okay. So now the effect of R. So we're looking at when R changes right here. How much of an impact does it have on option prices? And it turns out of all the variables that affect options, interest rates tend to be tend to have the smallest effect on option values. So when interest rates change like we normally see it, it usually doesn't have that much of a change in option prices. Although, as I showed you, it can have a piece to it, but compared to volatility, for example, it's not a big factor. And so you need to keep that in mind. Changes in interest rates are pretty small. Now, let's move on to the effect of a stock price volatility on option value. Now, when a stock has a lot of volatility, then that means the insurance value is going to be high. Notice volatility doesn't affect this directly, right? Assuming the stock price is unchanged, then there's no volatility here, and there's no volatility here. Okay, so all else being equal, the volatility is reflected in the call through its insurance value. Okay, now if there's a sudden change in volatility, then that's going to change the value of the call. Is going to become more valuable. There's a couple of things going on that you got to be careful of. We're going to have to make an assumption that if you own a call option and suddenly the underlying stock becomes more volatile and the underlying stock starts wiggling up and down a whole lot more, then you got to keep the stock price fixed, keep this fixed, this all stays fixed. What happens is the insurance value goes up. And think of it this way: the analogy is, if you're a really safe driver, then the value of insurance is not that great to you. But if you are a highly erratic driver, then insurance has a lot of value to you as an individual. Insurance has more value. That's one way to think about it. The other way to think about it is when a stock has a lot more volatility to it, there's a huge speculative value also that's buried. So you can call this intrinsic value or insurance value from its ability to hedge the underlying stock, which we'll talk about a lot in later chapters. But there's also a speculative value that you can think about right here, here for the insurance value. So what it means is speculative value means, look, if the stock is gyrating hugely up and down, well, then why don't you can wait and time it so that you buy the call when the stock is low here, and then you're going to sell the option when the stock is real high and make your profit because you know the volatility is high. That's the concept behind either speculative value or intrinsic value or insurance value, because insurance value means if you're gyrating back and forth, then you have a lot of risk with the underlying asset. Okay, so now let's go a little further and look at let's do a thought experiment. When the thought experiment is this. Let's look at a riskless stock. Now, there's no such thing as a riskless stock, but let's imagine there is a riskless stock. That means a riskless stock is one that has volatility measure. I mean, it doesn't have volatility. Its variance or volatility is zero. So what do you mean by variance or volatility? Well, here's a riskless stock over time, doesn't move. You know exactly where it's going, so there's no risk. Here is a risky stock. Okay, like all stocks you see on the stock exchange, things are gyrating up and down. There's really no such thing as a riskless stock, but work with me here and just imagine that there is a riskless stock for a moment. Let's see how that affects our interpretation of boundary conditions. So we have the risk-free stock. Then if we have a risk-free stock, we know exactly where the stock is going. And technically, the way I wrote this, it's a flat line. Technically, if you have a risk-free stock, over time it grows just a little bit. It grows. It goes up a little bit. You know why? Because if you have a risk-free stock, it has to grow a little bit because you're not going to buy something that's going to stay flat. Why would you ever buy something that goes flat? Why would you buy it here knowing that it's going to end up at the same price? Why would you spend money on that? You're crazy. So in finance, whenever you have something that's riskless, like a riskless bond, riskless stock, or riskless portfolio, if it's riskless, it earns the risk-free rate, which means it's got to be growing at a little bit of rate in today's environment because that's growing at the risk-free rate. Okay, so what I'm saying here is we can use this idea that if we know the fact that that the stock is riskless, we know it's going to grow at a certain rate. We know exactly what ST will be. Therefore, the value, let's look at a European now. The European value is going to be this. So notice here, I'm making an equal sign. Is going to equal the maximum of 0 or the stock price today minus the present value of the strike. Okay, so really what I'm doing is, here's what I'm doing. I'm saying the stock has no risk, so the insurance value disappears, right? There's no underlying risk, there's no insurance or speculative value because the underlying is not changing. What I'm doing now is I'm just moving this guy here back over to, and I'm not distinguishing here. I'm getting rid of this in isolation, and I'm going to put this difference over into the intrinsic value. And so what I'm saying here now is the intrinsic value of the option, this European, is equal to the call. The call is equal to its intrinsic value. Okay, So what I'm saying is that the reason for the lower bound that we saw earlier in the notes, the lower bound said this. That was the lower bound condition earlier in the notes. I'm getting rid of this greater than sign and replacing it with another half an equal sign. So we have a full equal sign here. And so what I'm saying is the reason for that, the reason for stock prices looking, or option prices looking like this. Remember I said call options kind of look like this in this space? The reason for this space right here is because of the insurance value, basically. Most of it has to do with the insurance value. And if you got rid of the insurance value, then this line, this curved line, melts into this graph right here over time. Okay, and so over time, it melts in because you have no insurance value, and when it melts in, the value of the option at expiration is either 0 or the payoff S minus X at expiration. And if you know at expiration, oops, there should be a T here, then you know exactly what this payoff is going to be. It's this area right here. Okay, it's this area right here. Okay, so I hope I gave you enough intuition about, you know, what the volatility does to an option. Much of it is right here, with little tricks of sliding this time value component over. You can see that really the reason for this height in this graph, it has to do with insurance value. It's nearly all of it, most of it. Okay, and when things mature, you're on this line. When the option matures, so to speak, and expires, you're on this line. So eventually, you know, it's kind of curved. The option price is kind of curved, but as time goes on, it starts to get this little kink in it, to the point where eventually you get a kink. The kink starts showing up, and then finally it just melts right into this line right here. So this is a natural place to stop if you want to stop the video before we cover puts. Take a break to digest what I just covered. So now I will cover put options. And it won't take that long to cover put options and their boundary conditions. Okay? Because we kind of have a good background already. And but I need to still cover it. And remember, you know, put options are conceptually just a little harder than call options. You just have to kind of flip your brain around to handle them. So hopefully you'll get more familiar with how they work, get more comfortable with that, with their idea. Now let's figure out the minimum value of a put. And we're going to use this notation, put option. And notice there's no A and there's no E here, which means this relationship that I'm going to show you applies to both puts, European and Americans. Okay, and so we have the value. This is the value of a put with a certain underlying stock today at subscript 0 price, time to expiration, which is a fraction of a year, and X, which is the strike. So remember, a put gives you the right to sell, the right, but not the obligation. You're not forced to sell. And you have optionality. That's why they're called options. And so the first condition we're going to see is that since we have that optionality, the value of the option is either 0 or greater than that. It can't be negative, in other words. And so that's how it works for a put applied to both European and American. And now remember, an American put can be exercised early, and you only exercise it when it's in the money. And so the payoff when an option is in the money, remember, is X minus the exercise, the stock price at the time you exercise it. So notice there's an implicit positive sign. Nobody ever writes the positive sign there, because when you sell the option, you're going to get this much in dollars, X dollars. You're going to give up the stock price. So there's a negative sign in front of it. Now let's look at an American option which allows you to exercise early, meaning at any time. So the notation here, the value of an American option is greater than or equal to its intrinsic value. Okay, so it's got to be greater than or equal to 0. If the option's at or out of the money, the payoff is 0. But if it's in the money, this is the payoff. So this is overall component is the intrinsic value. This is just the intrinsic value if it's in the money and you're contemplating exercising it. And overall, it could be that the option is out of the money, in which case you're looking at the 0. Or even at the money, the payoff is 0. When it's at the money, the X and the S are equal. So it doesn't matter if the 0 is here, the 0 is here. The maximum is 0. Okay. Now, this is for an American, but this does not hold. This relationship does not hold for European options. And the reason it doesn't hold for European options is because you can't exercise a European option early. And so you can't get you're not going to get this time value. You're not going to get this payoff X by exercising early with the European. So we have to make an adjustment, and the adjustment's going to for that delay of getting the proceeds with the European. So with the European, you can't exercise immediately. You can't get your hands on X. So we can only get our hands, if we own the option, we can only get our hands on X at a delayed point in time. So what that implies is we got to factor in time value of money. And here's what I'm saying. Let's look at the maximum. That's the maximum value of a put. And if we look at the maximum value of a put for an American, it's got to be less than or equal to X. Okay? And so the American has to be less than or equal to X, because that's the most you can get out of an option, out of a put option. When you have a put option, the only thing it can do for you is you have the ability to sell the stock, and you have the ability to get your hands on X. Okay, so the option has to be either X or less, because that's the most it can turn into is X. Now with the European, the proceeds are delayed when you own a European option. So therefore, you need to take into consideration the time value of money. So it's got to be, so the value of a European is worth a little less, and it's the present value of the strike, because you can't really get your hands on X. Conceptually, you can only get your hands on the present value of X because there's a delay in which you can exercise. So let's do an example. It's in your notes. Suppose we have both an American put and a European put, each with a strike of X. Okay? The risk-free rate is 4%, and the company just went bankrupt. So therefore, S equals 0, stock price today is 0, R equals 4%, X equals 50. Sometimes it helps us to write this stuff down as you're thinking and going through it. And the option has a maturity of 6 months. Okay? Now, we'll compute the upper bounds on both the American and the European. Well, the upper bound is it can't be any greater than this. This is the maximum it can be. So the upper bound is just plain 50 for the European, or excuse me, for the American. The European, on the other hand, you can't get your hands on the $50 until expiration. So what is that $50 worth today? Well, that $50 is worth $49.03 in terms of the present value. So the present value of $50 discounted at 4% for a half a year Turns out to be $49.03. Okay. Now, moving on. At expiration, what is the value of a put? At expiration. Well, it doesn't matter if it's a European or American, because at expiration, all you can do is exercise it if it's in the money, and if it's not, you don't exercise it, you get a zero payoff. So therefore, the value of the option at expiration, T equals 0, as I put in the notes, equals the maximum of 0 or x minus st. So see the st right there? It means you're at expiration. And so it's the maximum of this, okay? So we're right on the boundary condition, so to speak. And I'll show you that in a little bit. Now, how that works, you'll see that I'm going to draw you space, just like I drew the space for the call. I'm going to draw a space for the put. That's where I'm going here with these boundary conditions, because I want to show you where the price of a put should be. Where's the inbounds and where's the out of bounds? Because remember the three things we're getting out of these boundary conditions. One, we're going to learn how to value an option in part based on these boundary conditions. Two, we learn, well, where are the boundary conditions? Where should an option price be? Where should it sit? And three, if the option is out of those bounds, it implies there's an arbitrage situation that you can take advantage of. Okay, so now the next thing we want to do is the effect of time to expiration. Okay. And the effective time to expiration, all it says is, look, if you have a put, just like with a call, that the longer the expiration, T is greater than T1, then the more valuable the option will be. Okay, the greater, so that applies to both puts and calls. The longer the life of those options before they expire, the longer the life till expiration, the more valuable both a call and a put is. Okay, so keep that in mind. That'll be helpful later on. Now, believe it or not, we went pretty darn fast through this. Let's look at the space, the boundary space. And the boundary space is going to look like this. So here we have nice and big. I got space in the notes for you to be able to put this graph in. And so notice what we have here. We have the strike, the stock price, just like before, but now we're looking at the put. And with a call, by the way, when we did a call, this was 0 and it went up. Calls go up when the stock price goes up because you're bullish on the underlying. So now with a put, things when stocks drop, when the stock goes this way to the left, the put better go up in value, better go like this. So really what I'm showing you is in the literature, if you read it in other parts, the web, other research on it, these graphs are sometimes called hockey sticks. And so when I showed you a call and it looked like this, some people refer to that as this piece right here as a hockey, part of a hockey stick. Now I'm going to show you a hockey stick that in a second, I'm going to show you a hockey stick that goes like this. 0 above when the stock price is high, and then it's going to go up to pay off a lot when the stock drops. Okay, so let's do that now. First, so let's get into this story. First off, what we want to do is we want to remember we put the maximum value on an option, and we said for an American put, PA, the maximum was X. Okay, the maximum value for this, because remember, the most you can get, so this is the boundary condition, the most you can do with a put option is sell the stock for the strike X. So the upper bound on it has to be, you can't be up here where my hand is. you can only be down here below the line. So that's the upper bound on an American put. Okay, so now let's tighten up those boundary conditions and get a little more insight. And so let's look at the payoff when the stock price is above the strike. And so we're going to deal, so this is all American right here. And I'll show you the European in a second. In a couple of minutes, I'll show you the European story graph. But for an American, that's the most you can do. And then for every dollar the stock falls below the strike and you start moving in this direction, the option pays off $1. Because remember the payoff on an option, on a put is if the stock price is less than the strike, the payoff is S minus ST. And then if the stock price is greater than or equal to X, the payoff is 0. So I just graphed this component right here. Now, let's look at when the stock price is below the strike. Every time the stock goes down, this number goes down. This whole thing goes up $1. So the payoff looks like this. Oops. Pretend that goes right through the X, right through the X. Okay. So with an American option, you're going to have a space that you can't be up here, you can't be down here. You can only be in this area right here. That's the space that the allowable space that you're allowed with the European. And so notice there's no discounting of money. Remember when we're looking at European, we had X divided by 1 plus R to the T. And that applies to both puts and calls, but with an American, there's no discounting. So we're just looking at pure old X here. Pure old X is creating the boundary condition. And then what we have is, look, the actual value often looks like this. Okay, the actual value looks like this, and if you keep going down further, you actually come and touch this axis. So what that means is when you're really deep in the money, the value of the option is worth almost nothing. This height of this line is almost 0. And when you're deep in the money with the put, then almost the entire value of this put option is intrinsic value, this component right here. Okay, it's the X minus the S. That's the value. Very little time value or insurance value there. That insurance value and time value component, the longer the option is to maturity, the more valuable the option is. So you got different options here with different maturities. And also, if the underlying is more volatile, then you can have an increased value in the put. Okay, so when volatility goes up, it doesn't matter if it's an American or a European, and it doesn't matter if it's a put or a call. When volatility goes up, the option's worth more because of that insurance value. So what I'm alluding to, oops, dropped my pen. What I'm alluding to is the concepts of put value, intrinsic value, pure time value, and insurance value applied to puts. Yes, the concept that we saw with calls. So we got a put value, and that equals an intrinsic value. I'll just label it IV, intrinsic value, plus a pure time value, and an insurance / speculative value. I'll call it insurance value, but you can think of it if you're speculating with the put, it's speculative value. And that's driven by the underlying volatility of the option I was talking about a second ago. So now let's be really, really careful when we look at the math. Let's put the math behind it like I did earlier. And the intrinsic value of this option is going to be the maximum of 0, or X minus S subscript 0. And then it's going to be minus. Remember I told you that a while back that we're going to face a minus sign. Pure time value is negative, and it's going to look like this. Okay? And then we have the insurance value, whatever is left over. So when you want to decompose an option price, a put option price, whoa, I made a mistake. This should be put value. Okay, put value. See, if I was in a classroom, somebody would have stopped me, but nobody's in the classroom here, so I just kept going. So this is put value. So if we wanted to get a put value, say we went to the CBOE and we got a put price, that would be this number right here. And then we could easily, because we know the put is associated with a strike, we know what the underlying is, we can figure out what the intrinsic value is. We can figure out, based on interest rates, time to maturity of the option, what the pure time value is, and whatever's left over is the insurance or speculative value. Okay. Now, let's spend a minute on this negative sign. Remember, with an option, with a put option, you have the ability to get your hands on the proceeds right away if it's an American put. But with a European put, you delay getting your hands on those proceeds because you can only exercise it and get X at expiration. This is capturing that value, but that value is a detractor on the put value. It detracts from it because all else being equal, you'd rather exercise the option now and get the cash proceeds X and invest X over the life of the option and collect that interest. So when interest rates are high, boy, that can detract a lot from put option value because this term is negative. So remember, compare that to a call option. Call options give you the right to defer payment and buy the stock. Puts are deferring it, something that's good. And so since it's deferring something that's good in terms of time value, there's a negative component to it. So now let me derive the European boundary condition, and then we compare it to the more American we just did. But let me put that on here. I have space in the notes for it. Here we got the stock. Here we have the put. Here's X. Here's X. And with the European now, the European, since it's delaying the value of getting that cash proceeds, what we need to do is not just look at X. We need to look at X divided by 1 plus R to the T. In other words, the present value of X that we want to consider. Okay? So the present value is going to be something a little less. And we don't want to just look on this axis at X. We want to look at the present value of X. Okay? And so therefore, with a European, the hockey stick looks something like this. And this should be a slope of -1, by the way, meaning that every time the stock drops, the payoff goes up by $1. Okay? And then when you're above the X, the payoff is 0. So that's a European. Now the upper bound, so that's the lower bound of the European. The upper bound of a European put is right there. That's the max, upper bound. So the option can only be in this space right here. Okay? That space now can be compared to the American. So remember when I did the American put, I went from X to X. Here, pretend that goes right to X. And then I had the American upper bound with no discounting involved. This was the space. So the whole space for the European drops. Okay, so European, because it delays that value, the European option can be worth less than an American put. So the European put can be worth a little less than the American put. That's what it's telling you. All else being equal, and I haven't considered dividends yet, by the way, but I will in a second. So with a European, get their black pen here. I don't know if you can see that very well, the green versus black. But with a European, you can actually fall below this green line here. And the actual value of the option will look something like this. That's the space generally. So it can be anywhere in this space, this black from here to here to here. It can be anywhere in this space here. Typically, where it falls is along this line. And in later chapters, we're going to estimate that line. Okay? But notice you're falling below X here a little bit. And that's the negative sign. See this right here? This is incurred by the minus x over 1 plus RT. It's actually reducing it a bit from X. Because look, right here, from here to here, this space right here is this difference. This difference is right here. And then I'm capturing it. I'm capturing it at different stock prices. I'm down below. So that's kind of interesting. Those are the boundary conditions for American and European puts. Now let's think about dividends and put prices. When a stock pays a dividend, in other words, assume it goes ex-dividend, the stock price drops in value. We talked about that with the call. When a stock pays a dividend, the stock drops in value. But that's actually a good thing with put options, because you want the stock to fall. So when that happens, you need to put that into the intrinsic value of the option. So the intrinsic value is normally this condition. X over 1 plus RT minus the stock price. Okay? So we need to remember, adjust this stock price, and we're going to put that little apostrophe up there, where the adjusted stock price reflects the fact that it's the normal stock price minus the present value of the dividends paid over the life of the option. But so what happens is this S is smaller. This S is smaller than this one because this is getting subtracted off. This term, this term is getting subtracted off. So S apostrophe is smaller. S apostrophe is smaller. This whole term, this intrinsic value component right here, if it's in the money, that's bigger. So when it comes to put options, high dividend paying stocks with put options, the put options are worth a bit more because the stock's going to drop by the amount of those options, or the amount of those dividends that stock will pay off. Okay. Now, what we've shown here also in another boundary condition is that the European is going to be it's generally worth less than the American. So the relationship here is the price of an American put is greater than or equal to the European. And the equal sign gets invoked at maturity. So at maturity, you see this line right here that the marker's on? It starts to creep up, because there's no discounting left, and you're right on the same line as the American. And then not only that, but this component, this line starts creeping up right to the American. So you end up, I'll draw it so you can see it. You end up at expiration. You're on this line. This boundary condition is what you have, or you have this boundary condition, and that's where you fall. And then the actual option, as it approaches, something like that. So now let me cover early exercise of American puts. The question is, should we, or is it optimal to exercise an American put early? Remember, let's compare the call for a second. So remember when we looked at the call, we said that the call has an intrinsic value, pure, and insurance value. Intrinsic, pure, time value, insurance value. There's three components. And with a call, we said that first off, if a stock doesn't pay a dividend, it's never optimal to exercise early. You don't even have to look at this when a stock doesn't pay a dividend. It's never optimal. You just sell the stock and collect these two components. You don't even have to think about it. I shouldn't say you shouldn't look at this, but you don't really have to think about it because you're throwing away these two components on a non-dividend paying stock. Now with the dividend paying stock on a call, remember, it was a question of is the value of the dividend greater than or less than these components you're throwing away? So if you exercise the call, you get the stock, you get your hands on the dividend, and then you're throwing this away. So which is, you know, if the dividend is large and it exceeds these two values, then it's optimal to exercise the call option earlier. Now with a put, you don't have to worry about dividends because you're selling the stock. You don't get your hands on the dividends. Should I exercise early boils down to these two components. Now when you exercise an American put early, you're throwing away this negative part. So you're throwing away a negative is kind of a good thing, okay, when you exercise it early. So you need to consider when you're deciding, is this component greater than this component? Because that's what you're throwing this away, and that's a positive component. That's bad when you exercise the option early. You're throwing away a negative, which is actually a good. So you're trading off these two components when you're making a decision on exercising the American option early. Which one is bigger? And so I can tell you that if the underlying stock is highly risky, or the or the rates are really low and the time to expiration is low, which means this number is really small, then you're throwing away a negative that's in absolute value very relatively small. If that's small relative to this, when you exercise, you're throwing away this benefit. And so you're better off with a high volatility stock, selling the option, collecting the insurance premium, rather than throwing away this negative, which is actually turns out to be a benefit. The benefit's really not that high. The problem is you're throwing away the insurance value if you exercise early, or we can refer to it as the speculative value if you're holding the option for speculative purposes. But as we'll see later on, I often kind of go back to this insurance term here because we're going to value options based on their insurance ability. So, the insurance term does make sense, but it does have a speculative component to it if you're holding the options simply to speculate. Okay, so now what we want to do is let's move on to put-call parity. So we just covered calls, we just covered puts, and we just wrapped our head around those boundary conditions. Now we want to tie the concepts together in a relationship called put-call parity, which is extremely powerful. So put-call parity. Let me boil it down for you in one equation. Then we're going to derive that equation and talk a lot more about it. I'll give you some examples. Okay, so we're dealing with put-call parity. It's called a put-call parity condition. And it's for Europeans only, European options only. There is a put-call parity relation for American options, but it is nasty and ugly, and it's not used very much because it's simply too cumbersome. I think the textbook somewhere has a picture, has the formula for it, but it's like a double greater than or equal to sign. And boy, like I said, the intuition just fails, and so it's not referred to often. What's referred to in the literature and really valuable conceptually is this put-call parity for European options only. And so here's the formula. And this formula, I'll show it to you right here. This is called put-call parity. And so you have the value of a call, and I'm going to leave the E's out. I'm going to leave the E, I could have E here and an E here and a subscript 0 here. I'm probably going to forget to put those in, so don't worry about that. We're only dealing with Europeans, so technically if I tell you European, I don't have to write it in there. And the stock price, almost always you're dealing with a stock price right now, and if it's not, I'd always label it as ST. So we're talking about a stock price now. So the point of put-call parity is this. The difference between the value of a call and the value of a put equals the difference between the stock price and today and the present value of the strike. There's the relationship. You know, you've seen this before. This looks like the payoff to a call, right? And so the difference between these two is equal to the difference between these two option values. And so what I want to do is I want to derive this formula. But before I do that, one little comment is this is one way to show put-call parity. And this is just the way I memorize it. But there's a whole bunch of different permutations on how to write it. You can write it, the stock price equals blah, blah, blah. You could rearrange it to solve for S. You can rearrange it to solve it for P. You can rearrange it and solve it for X if you want. And so there's a whole bunch of different ways to write it. And if you go to the text, it may rearrange the formula. But this is basically the formula that I have memorized. And so whenever we're dealing with put-call parity, this relationship holds. And you don't really have to memorize all the different permutations to it. So now, one more thing before we get into the derivation. We're going to use no arbitrage conditions for derivation of put-call parity. And the thing that you're going to find out is, look, I'm saying that the calls, the option values, where are these option values determined? Chicago, typically, the Chicago Board of Options Exchange, right? Puts and calls are traded. We saw those quotes from the CBOE. And then where's the stock traded? Well, it could be anywhere, but think of it as the New York Stock Exchange. So we're looking at options on the New York Stock Exchange. And then you have a strike, which is related to the options. And then you have a risk-free rate, which is determined in the bond market, the treasury market. And you have T, time to expiration. And so we're looking at this. So the options market is tied to the stock market. This side has to equal this side. And if it doesn't equal, there's an arbitrage opportunity because you're kind of out of bounds. The other way, the other thing that you need to realize about this is the call and the put have the same strike. So this is the strike that's on the put and the call. And it's the same expiration. Okay, so we're looking at basically when we did those quotes and we did a call and we looked at a put on the quotes, we looked at the options chain. We looked at the very first example. So we had the same, when we were doing that, we were looking at each one had a different T3, different expirations, and we looked at X's. So they had the same X, the same T associated with it. So we're doing put-call parity. We're just pulling numbers off the row, the quote row, the rows on the quotes. You don't do put-call parity by looking at changing the time to expiration. So you have different times to expiration or different strikes. It's the same strike for both. It's the same time for both. So keep that in mind for this concept to work. And it's literally pulling rows off of the quotes that we saw. Now, let's derive put-call parity. And I'm going to do something similar to what I showed you before in derivation. We're going to look at, I wouldn't want to call them portfolios because it's just a portfolio of one asset, either a portfolio of a call or a portfolio of a stock or a bond. So we just really have a collection of assets. So I don't want to call them portfolios. So let me explain. Suppose today you're long a stock. So we're long a stock. We own the stock, or we want to go and buy the stock. We're going to be long a put. That means we're purchasing or we own a put. Okay, we're the holder of a put. And we're going to short a call. Okay, so if I buy a call, somebody had to sell it to me. The person who sold it to me has a short position in the call. Okay, and so those relationships are going to hold. So these are three different. You can think of it as portfolios, each one A, B, or C. That just makes it more cumbersome. It's just that we're long a stock, we're long a put, and we're short a call. Let's evaluate that situation. And we're going to build a table, and we're going to have the long stock here. We're going to have the long put here, and we're going to have the short call here. we're going to have current value. Looks familiar. This looks familiar with what we did earlier. And we're going to have payoff at expiration. And we're going to look at where the stock price is at expiration. Is it out of the money? Or, I mean, not really out of the money because we're dealing with puts and calls. Is the stock below the strike? Or is it above the strike? Okay. Now, let's fill in the table. Now, the current value of a long stock is S subscript 0, where the price is today. Looks familiar. We're dealing with European puts, so the value of a long put is P. Now, a short call, the value of it is minus CE because you shorted that call. Okay. Had we shorted the stock, by the way, we'd put a negative sign in front of the stock had we had shorted it, but we're long the stock. Okay, so think of these three assets as a portfolio combining. We're long a stock, we're long a put, and we're short a call. And this is the values of them. Now let's figure out, what is the value of, what is the payoff at expiration for the stock? Well, we saw before, no matter what happens, we don't care where the strike is because it doesn't matter. The stock is worth the stock, regardless of where it is relative to the strike. It's worth S capital T at expiration. So we saw that. That's not too hard to see. Now with the European put, okay, we can only deal with it at expiration. And what is the value? What is the payoff at expiration? Well, it's X minus ST if it's in the money. So we're looking at in the money. The payoff is the difference between the strike and the stock price at expiration. If its stock price is above the strike, the payoff is 0 for the put. The put is out of the money when the stock price is high. Now, when you short the call, this is a bit trickier now. We got to look at it from, in some respects, look at it from the position of the holder of the call. If the stock price is less than the strike, the call holder will never exercise it if the option is out of the money. Okay, so the holder will never exercise it. So you always have to think about, and this is kind of a tough thing to get a handle on, is you short the call, you sold it to somebody, but the decision on whether or not to exercise is always in the holder's hands, not your hands as a short. So you need to think of it, would the holder of the call ever exercise it if the stock is less than the strike? Absolutely not. I mean, they never do that. So the payoff is 0. And you're kind of happy if that's the case because, if you're short a call and the stock ends up below the strike, you're happy because you sold the call option for a certain amount of money and you basically sold an option that's worthless to somebody. Well, that's exactly what insurance companies do every day to you. So they sell you an option, they collect the premium, you keep your fingers crossed, they keep their fingers crossed that you don't ever have to exercise it because you never got in an accident and your house never burned down. So that's kind of great. It never got in the money, so you're never going to exercise the option, which is good. They sold you the option and they're quite happy. So there is the analogy is there. So from the holder's perspective, don't exercise, the payoff is 0. Now, if the stock price is above the strike, the payoff to the holder is this, ST minus X. That's the payoff to the holder. But you're short the option. You have to sell the stock at X when it's really worth a higher amount. You're not liking that. So the gain that went to the holder is the loss to the seller of the call, the person who has a short position in the call. Now what we want to do is let's evaluate the price relative to the payoffs. The current value of the option, or this portfolio, I should say, the value of this portfolio of 3 different assets here is the stock price plus the put minus the call. Oops. Okay. Now look what happens here. Let's figure out if we have this portfolio and the stock is less than a strike, what is the net effect of this portfolio? Well, you get the stock price, and then you get X minus the stock price. The S's cancel, and all you're left with is X. Okay? So no matter what happens when you're below this strike, you're going to end up with X. Now what happens when the stock price is above the strike? You're going to get ST, and you're going to pay ST and get X. The S's cancel again. The negative and the negative turns out to be a positive. And look what we got here. We got a situation where this is the value of our portfolio today. And no matter what happens to the underlying, the stock is going to mature, or this portfolio is going to mature for X. That's basically telling you it's risk-free. No matter what happens here, this is what you're going to get at expiration. See, at expiration, it's all you're going to get. So what is this worth today? This risk-free X, because no matter what happens, you're going to get X, or you're going to get X. The value of X today is 1 plus R to the T power, present value of X. Therefore, this is the present value of the payoff at expiration. The current value is this. We're going to set these two equal. You set those two equal, rearrange it algebraically, and you get C minus P. I'll put the E's in there. Equals S minus X over 1 plus R to the T power. There we have put-call parity derived under no arbitrage conditions. And so what we did was we formed a riskless portfolio. That's what we did here. We formed, and you would never think of doing this on your own. You really have to play with this for a long time. But what we did was we formed a riskless portfolio and said, no matter what happens, we're going to get X. And what is the value of X today? It's the present value of it. And so what is the value of this portfolio that pays off X no matter what? The value of the portfolio today is this. Rearrange it, and you get the formula that I'm showing you for put-call parity. And there you have it. One little trick is if the stock pays a dividend, then we substitute out the S subscript 0, we substitute it for S apostrophe. And S apostrophe is the stock price minus the present value of the dividends. Oops, sorry about that. There you go. So that's not a big deal. So let's do a couple of examples on this, and then we'll kind of summarize what we covered in today's lecture. Okay, so let's look at two examples. First example is pretty straightforward in the notes. Okay, let's look at the data, and the question boils down to, does put-call parity hold for this relationship? So here we have the Tasty Baking Company. Its stock price sells for $53 today. It has European calls and European puts that trade on it, and the European call is worth $6.74, and the European puts are worth $2.51. The strike is $50. The risk-free rate is 5.11%. Okay, and T is 1/2. The option expires in 6 months from now. So now the question, does put-call parity hold? So it really boils down to something, this is not hard. This question is not hard. It's literally plug the numbers in and ask, does the right equal the left? And if it does, everything works out. The Chicago market is in line, not by accident, because there's no arbitrage situations here. Arbs are waiting. They're forcing these prices to match. The Chicago market's matching the New York Stock Exchange. Maybe, I think Tasty Baking Company's in Philly, so maybe stock is traded on the Philly exchange. And then you have this strike here. So plug the numbers in. 674 minus 251. 53 minus 50 divided by 1 plus 0.0511 to the 1/2 power. Now keep in mind, I don't know if I told you this in earlier videos, but the interest rate you see is always on an annual basis. So the interest rate doesn't match the maturity. This is always on an annual basis, and we're putting it we're semi-annualizing it by taking it to the 1/2 power. Okay, so now if we solve this, we come to 423 equals 423. Aha! Both sides equal by no accident. They both equal. So the put-call parity holds. There's no arbitrage opportunities here. Things are properly priced with all these prices. In other words, everything's lining up. This relationship should hold every day throughout the day. And if it doesn't, there's an arb out there waiting to buy what's cheap and sell what's expensive to make a buck off it. And if they can do that with put together a risk-free position, and they can profit from it, that's great. I mean, risk-free, maybe there's no money down, there's no risk, and you're making a profit. Whew, that's exactly what those people are looking for. So there's people in the market looking for this, and they're forcing this relationship to hold. Forces that relationship to hold. Now let's look at an example where the relationship doesn't hold. And let's evaluate it carefully. So this example is a bit more complex because I want to show you where things are failing and how to take advantage of it. So in this example, it's the same example, except we're going to say before we had the call was trading for 671, and that was the appropriately priced call, or 674, I'm sorry. That's the appropriate priced call. But now we're saying that, this is the theoretically correct call, but now for some reason the call that's priced, that's actually trading on the options exchange is $5. So there's a mispricing of $1.74. When there's a mispricing, somehow, some way, ARB is going to see that, arrange a position to take advantage of it. And that's what we want to see here. So what we see here is that the call is worth less than what it theoretically should be. And if that's the case, that implies that we want to buy the call because that's cheap. Remember I told you we want to buy, whenever you do an ARB position, you buy what's cheap and sell what's expensive. Eventually the prices all line up. Because whatever you buy that's cheap, you're going to push the price up. And if you're buying something and you're going to sell something to offset it, and you're selling it pushes the price down. And so the prices tend to equalize after a while. It hasn't happened yet in this example. That's why there's a mispricing. So what we're going to do is let's rearrange the put-call parity so we have this. The call equals the stock price plus the put minus the present value of the strike. It's the same put-call parity conditions. I just moved the P over. Just move the P over. Because this is what I want to buy. This is what I'm going to buy in the open market. I'm going to buy this, and I'm going to sell this. Okay? And if I sell this, that means I'm going to sell the stock, which means I'm going to short the stock. I'm going to sell the stock. I'm going to sell the put, meaning I'm going to short the put. And then I'm going to buy a bond that pays off X. And what's it worth today? I'm going to buy the bond for its present value today. That's a bit to swallow. Think about it. Buying what's cheap, selling what's expensive, and we're going to make a profit off of this. Okay? So keep this in mind. Let me flip the page because I'm running out of space here. I'm going to buy the stock, buy the call, sell short the stock, sell a put, and buy a bond that's going to cost the present value of the strike, of what the bond is going to pay off. Okay, so here I'm going to buy the call. I'm going to short the stock. I'm going to short the put. I'm going to buy a bond. The cash flow today, so I'm going to look at it in terms of cash flow today. And then I'm going to look at it if the stock price is less than the strike and if the stock price is greater than the strike. So I got every condition paid off. Doesn't matter where the equal sign is. Doesn't matter. Okay? So now let's look at what happens here. How much is, so I put it here so it tells me how much cash I'm shelling out. And so when I buy the call, I'm going to pay $5. So my cash flow is negative $5. Okay. If I short the stock, I'm going to get the $53, the stock price. That was the stock price, just above in the first example of stock. So I'm going to collect $53 in cash. I'm going to sell the put, which means I'm going to collect $2.51 from selling the put. And then I'm going to buy the bond, and the bond is the strike of 50, discounted at 1.051, a little over 5% to the 1/2 power. This equals $48.77. I'm going to buy a bond for $48.77. And I'm going to buy it, there's a negative sign. Okay? That boils down to is I just collected $1.74. Okay, based on that, this portfolio, buying the call, shorting the stock, shorting the put, buying a bond with a payoff of 50, it's worth 48 today. I'm going to collect $1.74. Okay, now let's see what happens at expiration. So you know it's at expiration because I got the little capital T's in there. So I don't really literally have to spell it out. But it's at expiration. Now, when I buy the call and the stock is less than the strike, the payoff is 0. And when the stock is above the strike, the payoff is going to be S minus X. Now, let's add a little bit of reality to it so we can wrap our heads around this a little better. Let's pretend the stock price is 40. So remember, the strike is 50. I'm going to assume that it's 40 in this case, and I'm going to assume it's 60 in this case, 60 right here. Okay, so this is 50 again, 60. So we have actual dollars to put wrap our heads around here. So that means this is in the money by $10. So the stock is 60 at expiration, the strike is 50, the payoff is 10. Okay, so far so good. Now the stock price that you shorted, now you're going to have to buy the stock back at expiration. And if the stock is at 40, you're going to pay $40 to buy the stock to cover it, the short position. And here, if it's 60, you got to pay $60 to buy the stock back. So there's our payoffs, negative. Makes sense because you sold it for 53, you got to buy it back for 40. You're happy, you made $13. Here you lost 7 if the stock goes up. Okay, let's continue. It's a little harder with the short put now. With the short put, the payoff, remember, on a put is it's X minus ST. Okay, but since we're short the put, that's from the this is from the holder's perspective. We need to wrap a negative sign around that. So this is minus 50 minus 40. This equals minus 10. Okay, because when you short a, when you buy a put, you hope the stock drops. But when you short a put, you hope the stock goes up. And here the stock fell, and so you lost some money. The payoff on a put, when it's above the strike, the stock is above the strike, the payoff is 0. The holder will never sell it. Sell the stock at X when they can sell it in the open market for ST, so the option's out of the money. The bond pays off $50 no matter what. Okay, because we shelled out 48, it matures for 50. That $1.23 is the interest income. And it happens no matter what, because this is a riskless bond. And so when you add these up, no matter what happens, when you add all this up on both sides, the payoff is 0. The payoff is 0. We don't owe anybody nothing, so to speak. Right? We don't owe anybody anything. But we collected $1.74 with no obligation behind it. That's a pretty sweet opportunity. There's no risk. We collected $1.74 and didn't have to do anything. That is put-call parity. That is a violation of put-call parity. It's violation of $1.74. That should not happen in an efficient market. And that $1.74 is simply the 674 theoretical value minus the 5 actual. That's where the $1.74 comes in. It comes from the mispricing of the call option. Had the call option been properly priced, this would have been minus 674. This would have been 0. These terms would still be the same, 0, 0, 0. Well, it cost you nothing to get nothing. Well, that kind of works in an efficient market. So I hope that example works for you. It's kind of neat. It is a little complex. You got to think about it because you got to not only think in terms of calls and puts, but you're long and short. And eventually, this will sink in, and you'll see the ideas that we're doing here. But again, this is financial engineering, and so notice how you can combine. You build a house as a pile of 2x4s and nails and other things, and so if you know how to use those nails and those 2x4s and other pieces of wood, it's going to look like a nice structure, and that's what we're doing here. We're taking bits and pieces, putting them together just the right way. And if we put them together just the right way, we can value options, and then we can take advantage of them, take advantage of situations when things are mispriced. Okay, let's do one more example, and then we're going to summarize the chapter. So the example is Jupiter stock is $570. Okay, stock is $570. The risk-free rate's 2%. May is when this calls expire. The strike is $560. The premium is $17. What is the value of May put options with a strike of $560? Okay. What assumptions are you making to solve this problem? Well, we're going to assume put-call parity holds. Okay. Because if it didn't hold, we can't solve this problem. So what the question is asking, it's telling us, first of all, as soon as you see a problem like this, you think in your head, it just gave me the stock price. Let's think, 570 just gave me this. It told me the strike is 560. It told me this risk-free rate's 2%. It told me that it matures in 3 months, which is 3/12 of a year. It told me that the calls have a strike of 17, or no, the calls have a premium of $17 with a strike of 560. It's asking what is the value of the puts. So we're assuming we're assuming an efficient market here, that if we have all this information, we can solve for the put, assuming no arbitrage conditions. And so the value of put-call parity is, even if you don't have the value of the put, you can back into it with this equation, one unknown. And the put here is worth $4.23 in this example. So the point is, you can put together what's called synthetic positions. You don't have to actually, what's really cool about this is you don't actually have to buy a stock to get the action in a stock. If you rearrange this, and this is a little bit off, this is not kind of done with this example here. If you rearrange this formula, you'll get the stock price equals the call minus the put plus the present value of the strike. Okay? In other words, if there's no arbitrage conditions, you don't actually have to buy the stock to get the same payoff as the stock. So you can buy the stock and get the payoff from S, or you can buy a call, short a put, or buy a bond at its present value of the strike. And you'll get the same action as the stock. So you can synthetically create a stock without buying the stock. You buy a call, short a put, and buy a bond at its present value of the strike. You don't have to buy a call to get the actual call action. Because C, if you rearrange this, C equals S minus X, rearrange it, T plus P. If you go long the stock, you short the bond at the present value here, and you buy a put you'll get the same action as a call. So it's called synthetic. This is a synthetic call. This is a synthetic stock. And I jumped back here, and basically what I did was I created a synthetic put, and I solved for P. So at this point in time, people ask me, well, why don't you just buy the stock? Professor, why don't we just buy the stock and get rid of all this crap over here? And why don't we just buy a call instead of going through all this nonsense? And that's the point where I say, look, you don't get what I'm trying to tell you. What I am trying to say is we can value a stock based on these items without actually owning it. It's not about actually buying a stock through call and the put and the bond. It's not about that. What I'm saying is the value is equal. We can take advantage of that if that's the case. And so I did that up here implicitly. I've solved for P. You solve for P. I basically put together a synthetic put. And so that's how markets work. So you can put together synthetic options. Okay, now let's summarize the chapter. Okay, so here we're going to have a call. Here we're going to have a put, and we're going to put the stock price, the exercise price, time to expiration, stock volatility, which is denoted as sigma, just like the volatility in a normal distribution. Remember you had statistics and you wanted to know the spread in statistics, sigma denoted that spread. And then we're going to look at interest rates, and then we're going to look at cash dividends. Okay? And what we're saying here, in order to read this, you have to, it won't make any sense if you don't write this part down. And the part that you have to write down is what happens to the options price, okay, when the variable on the left increases. So when one of these variables on the left increases, all else being equal, so this is all else being equal to only the stock price changes, or only X changes, or only the expiration changes, or sigma changes only, the volatility changes, or the interest rate changes, okay? All else being equal. The only thing that violates the all else being equal idea is dividends, because you change the dividend, it changes the stock price. Remember this guy right here? You change the dividend, you change the stock price. So two things change at the same time. And so I'll address that when we get there. So now remember, what happens to the options price when one of these variables on the left increases? Well, when you buy a call and the stock goes up, you are quite happy. When you buy a put and the underlying stock price goes up, you're unhappy because it's going in the money, all else being equal. So it's negative. It's going to decrease the value of the put. Now, what happens if we could change X? And if you could change, X is fixed in the option. But all you need to do is you can see this relationship. If you go to the options chain, so remember we looked at an options chain. Everything else would be held equal, except the strike is 270, and then the strike is 280, and then the strike is 290, and so on. That's the same thing conceptually as changing X. Even though you can't change X, if you look at a quote that has various strikes all at the same, all contemporaneous, all at the same time, on the same underlying, same expiration, then conceptually it's kind of like thinking, well, what happens when I change the strike? If you could change the strike, oh, that's good. If you could increase the strike on a call, I misspoke there. If you increase the strike of a call, that means you just increase the value that you have to give up to exercise that call. You're not happy if you own that call and the strike is higher. With a put, you're happy because the put is what you strike is what you sell it at. So the put increases in value and the strike goes up, if you can imagine the strike going up. The other way to think about it is if you're looking at strikes that increase, then you're going to see all else being equal, higher put values as you go and see a higher increase in strength. Okay, now with time to expiration, the longer the call, the more valuable the call is. It's like insurance. Remember I told you call is kind of like an insurance value or has speculative value. So when the time goes up, the call goes up in value. Okay. Now the put is going to be positive also. So when you increase the time to expiration, if you could increase the time to expiration, and again, you could do that looking at quotes, because you look at the same underlying, the same strike, but look at different expirations, you'll see the puts generally going up, but not always. So I'm going to put usually here. Usually the value of the put goes up when the expiration goes up. So I don't think it hurts just to say, look, almost most of the time when the time to expiration, if it were to increase, the value of the put is more valuable. I footnote in the notes the exception to that, and it's quite involved. So I'll let you read that, but I'm not going to test you on it, on the underlying explanation. All I want you to realize is most of the time if you could increase the time to expiration, it's going to increase the value of the put. Okay? Now with volatility, when the underlying goes up in volatility, it becomes more volatile. The option is worth more, it has more speculative value, and from an insurance perspective, if you're using the option to insure the underlying stock, to hedge it and reduce its risk, then that insurance is worth more. And the analogy is the risky driver. Insurance is worth more to a risky driver than a safe driver. Now with interest rates, this is a bit more complex, but we can wrap our head around it, and we've already seen this. I've already kind of told you the story here, at least for the call I did. Put I'll elaborate on. Now, when interest rates go up, calls become more valuable. Remember the story that I told you for the call. I said, look, if you are bullish on a stock, you got two ways of dealing with that. You can buy the stock, which is going to cost you a lot of money, and you got to take money out of your bank account that earns a good rate of interest. The stock doesn't look that attractive in a high interest rate environment. Now, you could put the money in a call option. Call options are worth substantially less usually. So you only have to shell out a little bit of money to buy the call. And if that's the case, the call is relatively more attractive than the stock. Okay? So when interest rates are high, or interest rates go up or they're high, the call is more valuable. Now with a put, the opposite happens. It's a negative sign. I haven't really explained that. It's in the notes. Here's how to look at it. If you are bearish on a stock, there's two things you could do. You could short the stock, or you can buy a put. Okay, short the stock or buy a put. When interest rates are high, shorting a stock becomes attractive because remember, shorting, you sell the stock now and you buy it back later. If you short the stock now, you get the cash proceeds now. You can invest those proceeds at a higher interest rate. That makes you happy. If interest rates are high and you have to shell money out to buy a put, that's not very good. So puts become less attractive in a high interest rate environment. So that hence the negative sign here. Okay. Now, with cash dividends, as I said, two things change with the cash dividends. You change the dividend and you change the stock price. So if suddenly you saw an increase in dividends, okay, so dividends go up, you know the value of the call is going to go down because the stock is going to drop. When this happens, the stock will drop. The call will be worth less. Well, if the call is worth less because the stock dropped, it's a positive sign for the put because you make money when the underlying stock drops on the put. So this is a nice summary of the relationships between puts and calls and the changes in the underlying factors. So it's a nice summary of what we covered in the chapter. And we'll be employing these concepts later on in the next couple of chapters.